This episode is brought to you by Blockdaemon. You'll be hearing all about them later from me later in the episode, but now, on with the show. All right, everyone, welcome back to another weekly Roundup edition of On the Margin. I'm joined today, as always, by my co-host, my debonair co-host, Mr. Mark Yusko. And I'm throwing you the debonair adjective because even though you got in at 3 a.m. last night, you're looking great.
No, you are a good man. You are a good man, or you need stronger glasses. I feel literally this week, my senior year of college, I was walking across campus and my girlfriend's roommate said, "Man, you look like death warmed over, just not warmed over." I was like, "Wow, thank you." Yeah, so I should do the plan B today. I should kind of do, the video list, but we're going to go with it. And but I'm going to do the sock reveal. Probably not going to fall off my chair today, but I have the red pants because there's blood in the streets, and I have the rest in peace Bitcoin because everybody is back to Bitcoin's dead. And, I guess they could be right this time. No, they're not right.
They're not right.
They're not right. No, it's just so stupid. Well, we'll talk about it, but there is blood running in the streets, and it's ugly out there. The reason I got in at 3 a.m., I was in Dallas for a wealth management conference, and people were really down. I mean, they were really down. And then when I got there and talked about digital assets and Bitcoin, they're like, "Stop. Our other portfolios are doing like nothing. I don't even want to hear about other stuff."
That's so funny. Yeah, we're talking about Bitcoin, obviously, but it's not localized to Bitcoin whatsoever. I mean, it did feel like a plug got like, and, Bitcoin fell like 9% or something in the last 24 hours. We're recording this obviously on Friday the 6th, but, it's basically just nuclear fallout after the FOMC. So I've actually got a fun chart here. You'll see.
Fun, yeah. Fun depends how you define fun. Adjective. If you like torturing small animals, then fun. Yes.
Yeah. All right. So here's a fun little stat for you. This got pulled by our producer, Will. Shout out, Will. This is year-to-date performance of 10-year treasuries up to April. This is not the worst start for the 10-year treasuries in the last 5 years or 10 years. It is the worst start going back to 1787. 1787.
Love. Yeah. I love that you pulled this because somebody tweeted out last night. I noticed that it was the worst start in history. Obviously, they just don't know history. And you, being a history aficionado, have upped them. And this is so awesome. And that's so awesome. Yeah.
Look at this. Just to summarize, right? There was obviously the FOMC meeting this week. Initially, it looked like there was kind of a reaction in the wrong direction, right? So Powell kind of came out, he said a whole bunch of different stuff, but the big thing that it looked like markets were taking away was that they were not considering a 75 basis point hike, right? And markets reacted extremely positively to that. I think the NASDAQ finished up like 3% that day. Crypto, had a very similar result. And then the next day, Thursday, just absolute bloodbath, right? So the NASDAQ closed down something like 5%. The S&P did something similar, and Bitcoin puked. It's down, I think, 10% or something in the last 24 hours. So people really seem to reverse. I was talking to a friend of mine, Ash Bennington at Real Vision, and he kind of made this joke that I liked, which was basically like, everyone kind of celebrated like, "Hey, all right, we're not getting our 75 basis point hike." But then everyone went out at night and was like, "Wait a second.
Yeah.
Is this really that good of news?"
No, well, and what was ridiculous about it was they're like, well, 50 plus 50 plus 50 is not the same as 75 and 75. So it's like, what? And
I had the same reaction.
And again, he's like, well, we're gonna bring this in for a soft-ish landing. I'm like, okay, ish. Well, define ish. Like, is that a crash you can walk away from? Is that a crash you have to be hospitalized for? And look, if anyone has looked at any economic data, like not even a lot of economic, just any economic data, we're about to have arguably one of the biggest slowdowns in history economically. And if you've seen the picture of the ships in the harbors off China, this is intentional. I mean, this is definitely intentional. And I'm hopeful that we have enough resilience in our supply chains, particularly food supply chains, that this doesn't get like Dust Bowl Great Depression. But I'm not certain of that. And that's the first time I've actually said that out loud. But I am not certain that things couldn't get like ugly. And I don't want that. I'm not wishing for that. I really don't want that as a person, as a human, as a father, as a grandfather, as a friend. I really don't want that. But man, that picture spooked me.
Yeah. Just to directly outline the uniquely difficult position that central banks are in right now, what we're looking at here is, effective federal funds rate. And basically, whenever there's a yield curve inversion, which is what we are moving towards right now, right? I mean, it briefly happened, but, the Fed immediately after begins cutting rates, right? And, just to outline very directly what you and I have been talking about, I feel like for the last 6 months or so, is what's challenging about the Fed's position right now is that we are undeniably going into an economic slowdown, right? We talked last week about the contraction in GDP, 1.4%. The ISM and some of the forward leading economic indicators coming out of China look ugly, right? They're shutting things down still from COVID. You're right. All these ships out there. It doesn't matter if doesn't even matter the reason, right? It's just happening.
Exactly.
Right? So
that's the great point. It doesn't matter why at this point.
Exactly. So the Fed has, and we've got an 8.5% CPI handle. So, I mean, what do you do? And interest rates are at record lows. Like, what do you do in this situation?
Yeah, and the problem is you're supposed to learn from history. And again, it's one of the things I love about doing this with you is you have this great perspective on history and you always bring that historical lens. We know what happens when you raise interest rates from zero. It only happened one other time, but it was in 1937. And we know precisely what happens. And if you go back, and this is why, Lynn Alden talks about this. Everyone's like, oh, it's the 70s. I'm like, guys, there's just nothing about the 70s that's similar, except the CPI number. You could find a number in the 70s that was 8.5, but nothing else is similar. But you go back to 1937 and you look at debt, we were doing QE for the first time. You would look at interest rates were taken down to zero to try to stimulate the economy after the crash. And the Fed increased rates back then, only 25 basis points. Forget the 75. Because that's the thing, the Fed hasn't raised rates like 5%. They've raised rates 75 basis points. And 50 of those came in the last few days. So it hasn't been this massive tightening in terms of rates, but the financial conditions tightening that's happened in the marketplace from treasury markets and equity decimation has just been brutal. And in 1937, the Fed's actions turned a garden variety recession into the Great Depression. Up until our entry into the war, it was ugly. Like the pictures are ugly. And if you've read Steinbeck, it's ugly. Mm-hmm. And yes, there were weather issues and the Dust Bowl but we have food problems and we're seeing it already. And again, I don't want to be fatalist about this, but I do want people to at least acknowledge that there's an additional risk factor, which is just-in-time inventory. And we learned a little bit of that lesson during lockdown, right? When medicine, oh, wait, that comes from China? Really? That medicine isn't like 10 minutes away. It's, 2 days or 2 weeks away on a boat. So I think we have to be careful, very careful.
Yeah. Yeah, I completely agree with you. I was listening to I don't know if you've been listening to the All In podcast with Chamath and David Sachs. It's a good.
I need to do that. I sent it to myself. And I was going to listen. Actually, it's funny you say that. I was actually going to listen to it on the airplane, but then we didn't leave until 10 o'clock, and I was like, I'm going to try to get some sleep, and that was a disaster. And anyway, so I will recover this weekend.
Yeah, they bring a pretty interesting perspective, right? They've been talking a lot about macro recently, and but they're private market investors for the most. I mean, Chamath does a lot of public market stuff with the SPACs, but one wonder that I have, right? When I'm looking at everything that's going on with the Fed in general, is I want, like, especially if you look at just what's going on outside of crypto and some of these tech stocks, right? I mean, the charts are like, there's some of the ugliest chart. I'm not a chart guy, but there's some of the ugliest charts I've ever seen. And it's crazy. It's like, you can look at March of 2020 when the balloon got blown up, and now it's right back down. I mean, and everyone, maybe what's different about it this time is everyone is in the public conscious is extremely aware of the impact that the Federal Reserve has had on this period of time, right? So now it's like, that whole stimulus, the record stimulus, lasted about 18 months. Yep. All of the effects of that are down, and now we're about to feel the hangover. And the Fed is very much in the crosshair. So I'm wondering if the Fed always kind of steps into, I mean, at least for the last 50 or so, they step into markets and they kind of have this impact on the business cycle. But it could get pretty ugly politically for them, because I think a lot of people, if we do have some kind of, we're looking at a pretty massive drawdown already. But people could be looking to point a finger, and I feel like the Fed is going to be right in the crosshairs of that.
Yeah, I don't know. I don't know if you guys will be able to see this. I don't know. Yeah, maybe. Yeah. So that is every chart in tech. This is the classic bubble chart, and you go from this euphoria phase, and then you have the first drop, and then you have the return to normal, and everybody's like, "Oh, it's going to be fine. It's going to be fine." And then the bottom falls out, and everything that you thought you had goes away. And that is, Peloton and Shopify. And here's the problem. You look at some of these things. Yes, they're down 75, 85, 90%. They're still not cheap. They could fall another 75% from here. And, I've talked about this, right? The rule of 95, right? What's the difference between down 90 and down 95? You lost half your money. And so it's only 5%. No, that's half of what you got left. And so and I think we did, I think I picked on these guys last week, but, Carvana, that equity literally could be worth zero. They signed a debt deal that basically, gives Apollo the keys, pun intended, if they go bankrupt. And if they go bankrupt, then your equity, well, unless you're Bill Ackman and you get Jamie Dimon to let you have your equity in the real estate company that he had a big piece of, that filed bankruptcy, and the common somehow didn't get canceled, and it became the best performing stock over the next 5 years. I'm like, wait, how does that? No. But if you have special friends, things happen. I don't have those special friends.
There's a guy, you're the rule of 95. It made me think of this. There's a Twitter thread from a guy named Bill Gurley. Right? He's kind of one of the all-time greats.
Best.
It's a short thread, so I'll just read it to you here. So he's an entire generation of entrepreneurs and tech investors built their entire perspectives on valuation during the second half of a 13-year amazing bull market run. The unlearning process could be painful, surprising, and unsettling to many. Some thoughts. This is exactly what you said. Previous all-time highs are completely irrelevant. It's not cheap because it's down 70%. Forget those prices happened. Valuation multiples are always a hack proxy, dangerous to use. If you insist, 10x should be considered amazing, and an upper limit over that is silly. You may be shocked to learn that people want to value your company on free cash flows and earnings. What a thought. Facebook trades at 14 times GAAP EPS and it's growing 23%. What earnings multiple are you assuming? Revenue and earnings quality matter. I mean, these are like such basic things, right? But they're things that we seem to have forgotten.
No, they were gone. And every generation forgets them. And the interesting thing about investing is you don't get to learn from other people's mistakes. And it's really weird, right? You should be able to go back and read books about 2000 and look, 10,000 companies were formed by venture capitalists, Bill and others. And Bill is one of the greats. I mean, we were lucky. We met the Benchmark guys in Benchmark 1, all 5 of them, right? When they were children. I mean, they weren't children, but they look like children. All tall, very tall children. But they came to South Bend, Indiana in the middle of winter with no coats. That was funny. With no coats from California. And said they're going to raise this $85 million fund because that was the right number, 17 million per partner, and only 6 board seats per partner, none of this 20 board seats and nonsense. And make a long story short, that fund was, up until a couple of years ago, the best performing venture fund in history, a 96x fund. It was the eBay fund. They turned 85 million at 8.6 billion. So pretty good deal. But and Bill has been just a constant voice of reason. He wrote a great piece about SPACs and why SPACs would become the preferred method for high growth innovative companies to go public. But 10,000 companies were formed from 1995 to 2000. There are not 10,000 good management teams. There aren't. I mean, to zero, gone. Okay. Now that left 3,000 to go public or get acquired. And some today are some of the great companies of all time. Maybe not of all time, but some really good companies like Splunk and others. Actually, Splunk was formed later. Splunk actually came in 2001 in the middle of the crisis. But there are a bunch of companies that survived. But this idea that every company is great and every company should be valued on eyeballs and TAM. I hate TAM. This whole idea, what's my total addressable market? It doesn't matter. If no one cares about you and no one buys your product, I don't care how big your market is. So, and in 2001, there's a great article, I've tweeted this out before. In 2001, there's a great article saying, the novel concept or quaint concept of profits is back in vogue. What are you talking about? Profits is the whole purpose of having a business. And the idea of, we'll lose money on every item, but we'll make it up on volume. Okay, that doesn't work. Or, we're just going to keep growing our market size. It's okay to lose money. Now, Amazon made that work. Facebook made it work because then they could figure out a way to monetize. That doesn't work for every business model. There are a couple of business models. It's painful right now, and I'll tell you where it's going to be really painful is venture, because the public markets have already corrected. The venture markets haven't corrected yet, and we're starting to have some painful conversations with founders about, what they thought their value. It's like I remember one of my guys saying, he was talking to this guy. He's like, a market average, I can't remember the phrase he used. Basically, he was saying, the common multiple of 30 times sales. No, there's nothing common about 30 times sales. And people who paid 30 times sales, most of them will lose all their money. But, and look, Zoom got to 120 times sales, and, I shouldn't say anything bad about my son's company, but Snowflake got to 200 times sales. 200 times sales.
Yeah. 200?
I mean, there's no math formula. I was down in Dallas for this thing, and today, starting today, tomorrow, and Sunday, there's a market disruptors conference with Mark Moss and Greg Foss and James Lavish. I had drinks with James last night, and a bunch of people were coming. I missed it, because I had to get back to help my parents move. And Greg is just great about this, right? Learn math. Math is really, really important. And he's on the bond thing. And the reason bonds are getting crushed is math. And if interest rates do actually rise, then these multiples are going to get crushed. And that's math. And then if you can't earn any money with your business model, that's math too. So, and it's not calculated. He's funny. He's like, it's 11th grade math. You don't need calculus. It's just 11th grade, addition, subtraction, algebra. Pretty simple stuff.
Yeah. Sometimes I don't. So like going back to like, let's put ourselves in the position of Jerome Powell here. Let's say global central banks in general, and let's just ask ourselves, what is an acceptable outcome from the current situation? Because we're talking a lot about valuations in the stock market, public and private, but we know that the Fed is going to be watching credit markets, right? Short-term funding markets, especially. So I guess my question, I saw this tweet, the other day. So this is a pretty interesting statistic. There have been 2 days in the past 25 years when the S&P 500 futures were down 3% and 10-year Treasury futures were down 1%. October 9th, 2008 and March 18th, 2020. Someone is blowing up. This is forced liquidation.
Correct.
So, the question is, right, until the Fed is going to keep doing this until something breaks, right? And everything moves down precipitously in this same direction all at the same time. The question is, when is that going to happen? And then what can they do in that situation? I'm not sure they can throw a liquidity bazooka at it the same way they did in those situations.
Well, no, okay. So that's all of that analysis is perfect, except the last part, they collectively, right? Not just the Fed, but the other central banks have up to this point always been able to surprise us.
I know.
Right?
Yeah, they have.
Because we've said, there's no way at 80% of GDP on the balance sheet of, the Bank of Japan, there's no way they can go higher. They went higher. There's no way Japan could get to debt to GDP of over 200. It went higher, 226. And so the ability because it's the ability for the central banks to punch the button, because it's not even like they have to go crank out the money, right? They literally just push a button and more ones and zeros appear in some ledger. The challenge is that there has to be a willing suspension of disbelief by market participants, right? We all have to ignore the man behind the curtain and believe that somehow all of this can get reconciled and settled, when the reality is that's not possible. And so as long as we all believe it, and as long as we keep exchanging those certificates, because it's not really paper anymore, it's just electronic. As long as we keep exchanging for goods and services, it all works okay. And so your point is, what do they do? Well, at some point, the breakage will be so big that political pressures usually will force the hand to expand the balance sheet. And the PBOC already started, right? The PBOC cut their balance sheet in 2021, which is why Chinese equities just got myrtleized. They're now expanding the balance sheet again, and Chinese stocks have held up better than the rest. I mean, they've still gotten hurt, but most of the hurt was last year when liquidity was. So, and the ECB is still cranking out, although that's not really helping their markets. So at some point, I think they're just going to crank the printing press back up. And the relief rally when that happens will be epic. You thought, the other day was big, 3%. No, this would be, a big relief rally, a big short squeeze, because the shorts had basically gotten buried asunder, 6 months ago. They're pretty much gone. I mean, there's no shorting. People are back in the short side. They've made some money. It's the long side that's getting just killed. I mean, all the articles have come out now, and everybody's seen some of the, masters of the universe get their comeuppance, which does happen. But I'm with you, Michael. I think this, I don't like the term "this time is different," right? I mean, Sir John was right. It's not, but there is something that feels it feels 1937-ish to me. And I've been saying this for a while. It feels 1937-ish to me. It feels like they've made a mistake. It feels like we're going to have a reset, right? A great reset. And that means, unfortunately, a lot of pain, a lot of bankruptcies, a lot of, this is a total non sequitur, but here's an interesting one. So I don't think we've talked about this. There's a firm that we've worked with over the years called JB Investments. And they're amazing. They've been around 20 something years. There is a fund like every 3 years. And here's what they do. They look for an industry where there's been supply disruption through bankruptcy. They've only had 7 funds in 20 something years. And they've done it twice in the airlines, once in auto parts, once in met coal, once in some other industrial industry, and then most recently in energy. And, we invested with them 2 years ago in energy when everyone thought energy was dead. And they made 5 times their money. And they just sold last quarter. And now they're going to wait. And I was talking with this friend of mine in Dallas yesterday, and he said, I think the next one like this, where there's going to be massive bankruptcies. You've already seen a bunch of accidents in food processing plants, is food. And I'm like, oh, Jesus, wait a second.
That's dark.
If food companies start going bankrupt and and so I'm gonna talk to the JB guys about this, but that was 1937. Some of the great franchise businesses went bust, and the robber barons came in again and scooped them all up, just like they did after the Great Depression. Some of the great fortunes in this country were created by stealing the assets at the trough, right?
Let's talk about some things. So we've kind of covered a couple things that are unsustainable, right? We talked about valuations in the stock market, right? These like 30 times revenue multiples you're getting in private markets. I didn't know Snowflake was at 200 times.
At the peak. And it was only for like 5 minutes, but still it did hit 200 times revenues.
Yeah. Here's another one that's unsustainable is debt to GDP. Everyone has just kind of forgotten that or pretended that it doesn't matter because, and again, this is like I don't have a background in finance, right? I've been in financial media now for a long time, but it's just never made sense to me. And what people say is, well, when interest rates are really low, you can pay the debt servicing cost and it doesn't matter. And you can essentially take on infinite debt, explain down to me as if I'm like missing something.
Yeah.
And I'm like, yeah, for a time, but
exactly.
Come on, let's just think first principles. That's unsustainable. So actually, in a weird way, maybe the best outcome for global central banks in general is that thing everyone's been saying for a while is that some amount, 8.5% inflation, no, too high. But maybe some sustained inflation above whatever the 10-year yield is, right, so that bondholders just get punished for a period of time. And then if you don't make money in bonds and you got to put it somewhere, it goes into stocks, and like it will be rough and volatile, but maybe that is the quote unquote long-term soft landing that the Fed and the central banks are hoping for here.
Again, for a non-financial guy, you're pretty good. Yeah. So think about you just described financial repression 2.0.
Mm-hmm.
Okay, so financial repression 1.0 was we cut interest rates over and over and over and over, and we just push people out of cash, and they have to go somewhere. So they actually go into longer duration bonds. They go into high yield bonds, and a bunch go into high yielding equities, and even some go into speculative equities. Now you're at a place where, cash is totally trash. I mean, losing 7% in real terms or whatever, 8% in real terms. So total trash. And even bonds now are total trash. So if now the financial repression 2.0 is, well, geez, I don't even want people in bonds. I need them all in equities. But the problem is I don't think the planners who would have gone down that path, as you describe, would have wanted a 70% off sale. I don't think they would want, although maybe because, actually, the more I think about this, that makes a lot of sense. Because what you need is then for the money that gets invested to then have the ability to ramp back up. Because at the end of the day, the challenge for all of the Western civilizations is massive entitlements, not enough capital, and not enough workers. So the taxing base, when they set up Social Security, there were 17 workers for every retiree back in the 30s. When I reach retirement age, which means I won't get to retire, there'll be 2. And that's not enough. And so you're going to have people's houses appreciate rapidly, which is happening, right? We've created this massive bubble in housing. Although the problem is most people can't unlock their equity. Although I met a really interesting company that I actually might invest in. It's a great idea. Using blockchain and tokens to unlock homeowner equity, not through the traditional method where you have to get a home equity line of credit and you actually have to make a payment. But if you have a bunch of equity, but you don't have any more income, in fact, your income is going down because food prices and stuff is going up, you can't afford a HELOC. But if you could take 40% of your equity and sell it to somebody with a token, ooh, that's really cool. And let's say it had a feature like a ticket where if somebody then resold it, you got a little piece of it back. That would be really cool. So I think that could work. But then the 401k problem, right? If your 401k just turned into a 201k, or maybe it's only a 301k right now. It's on its way to a 201k. But if your 401k is now a 301k, we got to get it back to a 5 or a 601k because people don't have enough money in it to actually retire. And there's only so many, Walmart greeters there can be as you walk in. I guess there could be 8, you walk in. But then Walmart's margins would go down.
This episode is brought to you by Blockdaemon, the world's leading blockchain infrastructure platform. Blockdaemon's mission is simple. Make spinning up a node so easy a 5-year-old could do it, and so secure that any chief compliance officer in the world could sleep easy at night. In plain English, Blockdaemon allows anyone, whether you're a crypto-native fund, a financial institution, a DeFi protocol, whatever, to participate in crypto more safely. For some, that can mean participating in governance. It could mean gathering real-time and accurate data. It could mean generating yield through staking. Whatever it is, when it comes to crypto, infrastructure is edge, and there's simply no better edge offered than the one from Blockdaemon. Blockdaemon supports a range of services on over 50 protocols, and that's a growing list. They have multiple layers of risk mitigation that include regional and data center diversity, 24/7 human and automated monitoring, a full-service team of engineers to avoid technical difficulties, and things like slashing insurance. In other words, they literally make it foolproof. If your organization relies on real-time, accurate data that comes from blockchains, please, please, please click the link at the bottom of this episode and go check them out. Again, it's important. Gotta click the link at the bottom, otherwise I won't get my credit. They would. Then here's the last, talking about Walmart's margins. I'm going to connect these dots here. But the last thing that feels unsustainable to me is the wealth gap. Like all those things, stock market valuations, debt to GDP. But the real thing that feels absolutely unsustainable is the gap in wealth in general. And listen to what you just said. The big challenge for Western civilizations is a shortage of labor. Could it just be like, so then the premium on labor is going to increase and that's probably a good thing. Capital, like financial assets probably should be worth less relative to labor. Yep. Let me ask you another, here's a hypothetical. Yep. Let's look at something like McDonald's or Walmart, right? So what the arbitrage that companies have been playing on the global stage for the last 30 or 40 years in this globalization era is, I don't want to use my local labor pool, which is at whatever cost basis. I want to go into this other jurisdiction, use a cheaper labor pool, right? So what that does is that's a fixed part of let's say McDonald's costs, right? Or not to say McDonald's because they've got employee, like Walmart's costs.
Yeah.
So what? So people in the US earn less wage and Walmart's profit margins goes up X percent.
Yep.
Doesn't that just have to reverse? Also, shouldn't it reverse? Like, at the end of the day, who cares, man? Who, like, seriously, at a really high level, what is the societal benefit of people earning a living wage versus 5 points in gross margin for Walmart? I would argue we should probably just start paying people more, you know?
Look, like, you know, perfect analysis, absolutely spot on as what should happen. Problem. It's antithetical to the dictator playbook. We have entered the dictator playbook over the last few years, and there's no stopping it. And look, the powers that be in these civilizations, in these liberal democracies, have converted capitalism to cronyism. They've converted democracy into kleptocracy. And they, by pushing all their cronies to the tippy top of the spear, the plan then is to impoverish those below, not raise them up. It's literally to impoverish them by destroying everything around them, especially through currency devaluation, and then stay in power. Because I would ask this question, like, well, if the bad people got in power, just vote them out. It's a democracy. Oh, no, au contraire. The bad guys then, bad guys and gals like Christina in Argentina, then give free stuff. Like, what did Biden just do? He said, hey, if I forgive your debt, your student loans, will you vote for me? I know young people don't like me, but would you vote for me? And first it's student loans, then it's going to be, I don't know, then maybe they'll bring back, credit card interest or payday loan interest, or, I'll exempt some of your gains on your crypto. How about that? Would you like me if I did that? And you're going to see all kinds of graft being given to the floor to keep the floor from rising up, I think. And that, it saddens me. I don't like to say it. I don't like to talk about it. I wish your perfect analysis would happen. But the only way that would happen is actually, there's a way. If we got a young person in charge.
Yeah, I do think the age thing. But one thing I would say is, I think also like this. I mean, one thing that people are just starting to talk about, but I think will be bigger and bigger and bigger going forward into the future, is a rising labor movement in the United States.
Sure.
Just look, this is like, I'm not going to call my shot here because I think this is like a 5 to 10 year type thing. I listened to this interview. There's an episode on Pivot. And I listened to this woman, Kim Kelly, she's the author of Fight Like Hell, The Untold History of American Labor Unions. Mm-hmm. And I kind of went in being like, I'm not going to like what this person is saying, but I still listen to stuff. I still listen to that kind of stuff because I like to see what people are saying and narratives. Mm-hmm. And, she's talking very passionately about kind of what we're talking about, right? The labor class versus the ruling elite sort of class. Mm-hmm. And the one thing, she was saying some stuff that I thought was kind of radical, but I was like, I had this knee-jerk reaction where it's like, I don't really like what she's saying. But then I was like, but I kind of actually agree with that. I kind of agreed with some of it.
100%.
The way she framed it, there was an analogy to crypto that really resonated with me because one of the guys on the podcast, this guy Scott Galloway, he's like an older, mm-hmm. Successful kind of capitalist guy, and he's like, "Look, I like the messages that you're saying, but how could we essentially water this down so that it sounds good to a capitalist?" She's like, "Absolutely not. We're not watering it down. This is a fight." Oh, and what? We're not watering this down. No. And you know what? It reminded me of crypto a little bit because, so many times like, hey, I agree with this, but like, how could we say this so that it will be attractive to a Wall Street crowd? And I used to think about that too. And now like 4 years later, I'm like, I don't care if it's attractive to that.
Well, that was one of the things, Michael, that really kind of bugged me was when the Bitcoin world and the crypto world kind of backed off a little bit on well, you definitely can't use Bitcoin to get around sanctions. Like, horse shit, you can't. Of course you can. And why would you do? Well, I don't want to get them mad at me, as a hodler. So I'm just going to say that. Like, no, don't back down from your principles. And I love that. I love that. I'm going to listen to this podcast because I think, look, it doesn't have to be Jimmy Hoffa and, that kind of labor union stuff. But there is collective activity or collective action is a very powerful thing, right? And with social media, you can make it faster and more viral and more powerful. I think the one challenge as I sit here and think about your idea is what is that labor, right? I mean, is it truly the labor of the gas station attendants and the Walmart workers and the supply chain and the truck drivers, or is it the creative class that is going to build the new infrastructure for the new financial system and all of the new that's coming? And that's an interesting question, because it's kind of like, again, I was having this conversation. Of course, you're in Texas, you had to have this conversation that, everybody wants oil to go away. Everybody wants oil to go away, right? We all want this green future and no more decarbonization. And like, okay, look at the things that you use every day. How many of them contain or were manufactured by or brought to you by petroleum products? It's a big thing. And there's this ad, and I wish I could remember which company did it. It was awesome. It was an oil company, and it showed a guy and a gal getting ready for a date. And like every 5 seconds, something made of petroleum would disappear. Like literally, she'd be putting on her lipstick and it would disappear out of her hand. And he went out to his car to get in the car and the tires disappeared. And then they're sitting at the table and the food disappeared. And I'm like, you know what? That's pretty cool, because until we come up with, through innovation and something to replace it, let's just not pretend that I can, do away with all this stuff, just like the labor force, right? I mean, we need truck drivers and we need stockers on, for shelves, and until all of us sit on that levitating chair, like in Wall-E, and people just bring us stuff. Someone's still gonna have to bring us the stuff, I guess. I guess drones could bring us.
Look, I mean, I kind of feel like one idea that I think people have known for a while is broken, but is probably going to come out in stark relief over the course of the next 5 years, is this idea that people need to work like 3 minimum wage jobs to support their livelihood. Look, one of two things needs to happen. Either automate those jobs away and then figure out another solution. And I understand how painful that will be for an economy. Do one of two things: pay those people more, or automate those jobs away and then figure out what your labor force should be focusing on and doing. I don't know. One of those two things needs to happen, because this, like, working at McDonald's and Walmart to like support yourself and still not having a good life, that's just not going to work over a long period of time.
Yeah. Well, and to that point, it is basic supply and demand. If there are too many untrained people, meaning untrained, meaning trained for higher level activities, computer programmers or engineers or architects or whatever it is, but for this many jobs, then wages will fall.
Yeah.
And that's just that. It's like teachers. I think teachers, particularly like second grade teachers, because I don't know if we ever talked about this, but do you know the number one reason why people go to prison? The score on the second grade reading test. If you score below a certain number on the second grade reading test, you will go to prison, because you fall behind, you're ostracized, you drop out, you go to prison. They determine where to build prisons in this country based on the scores on the second grade reading test.
Is that true? I'd be really bummed if that is the case.
It's absolutely true. And I got this directly from a prison warden. It changed my life. It's why when I set up Morgan Creek, I set up Morgan Creek Foundation. We give 10% of our profits to early childhood education. It's my thing. So second grade teachers are really, and actually preschool teachers are even more important to me, because that's when you teach kids to read. And teaching kids to read is not really that hard. Tutoring one child, great, awesome. But figuring out how to motivate or take some of those displaced workers and create a better process for teaching kids to read would be amazing. And it's stuck with me all these years that this is something that, again, takes leadership. It takes people to aspire to that and to not want to just profit maximize at whatever corporation they have become a cog in. And there are lots of people doing this, right? There's this amazing kid. He was a Robertson Scholar. Julian has a program here at UNC, and he created a program that it's not second grade reading, but it's basically high school like tutoring to help people get through high school and get into college, called Student U. And it's amazing. And he's changing the world. And not everybody has to go do that, but we should all support those people, and we should all aspire to be like those people. And then we should all try to think of ways that we can use our brains to help facilitate those types of projects. But anyway, commercial break for early childhood education.
I don't want to overly fit this framework here, but I've talked to Neil Howe recently, and I like his framework, honestly, for the fourth turning. And I know that's more of a social, but I mean, just look at what we're talking about here. The institutions that have served us thus far look, it's painful when they crumble, right? That's because that's a lot of what society is based on. But, I think we're reaching logical limits across a whole bunch of different areas. We're talking about just, do you feel represented by your bank, by your government, the two political parties that exist, right? Is education serving you, right? Is the media, do you feel like you're getting good information from the media? And all, if the answer to all of these things is no, then ultimately that's okay, but we need to figure out a solution. And those solutions, the optimist in me, historically, those solutions get figured out. And just like in a company too, if you've ever had to, one lesson that I've actually learned about, just operating a company is that it's very tempting when you know something is wrong to paper over the solution. It's really tempting because it's a huge pain in the butt. When you finally shine a light on the problem that it will be messy and take extra hours. But sunlight is the best disinfectant. And this lesson I learned time and time again is just call the problem out, take your medicine, and then you'll be really happy that you did in like 3 to 6 months.
No, 100%. And I think we may have talked about this, but back to labor, tying labor in this. Boone Pickens, famous oil guy. T. Boone. I mean, just it's amazing, right? I mean, at 78 years old, there's this great video of him. Two videos. One, there's a video of him racing Obama up a hill, and he wins. Okay, and he's 20 years older. The other one is he's at a football game at OSU, his alma mater, and the cheerleaders are carrying this push-up platform, and he's on it at 78 years old doing push-ups. I'm like, that dude he's the man. So anyway, he was on Jon Stewart's show years ago, and John said, sir, I have such incredible respect for you, and you have this reputation of being tough yet beloved, and you have this reputation of firing a lot of people, and I'm just curious, how do you know? He says, the first time it enters my mind. I'm like, oh my God. And how many times, whether it's a person or a problem, or it enters your mind, and you're like, oh, no, I can deal with that. I'll tolerate that. It's okay. It's okay. It's not okay. He said, just do it. And then in the end, T-Boone gave a couple of life lessons, and Jon Stewart is great. He says, sir, I don't know where you're going after this show, but I am following you. I am following you out of this building. I am following you anywhere. I'm like, yes. So, and that's what we need. And I watched this guy talk, strategic investment conference that John Malden puts on. So I did one of the opening sessions, and I have a big session on Monday, my birthday. So they gave me my birthday day. And so there was this political strategist, and he said, for the first time ever, which is it's a long time, first time ever, his polling suggests that an independent third-party candidate could actually win. And the highest ever was Perot, I guess got 11%. He said, this time, a third party, but it would have to be the right candidate. And it has to be a charismatic, I think it has to be a young person. I mean, maybe not super young, but I think younger is better. But it just, I think it could happen. And I think if we collectively came together, the people in the middle, I just think it could happen. And I would love to see that groundswell movement happen.
The political parties are changing. They who's the geopolitical Peter Zeihan said this a little while ago. And, he kind of called this, I was listening like 3 or 4 years ago, Trump broke American politics. He broke the Republican Party. And he made this observation that we've talked about this on the show. Political parties tend to break and reform about every 80 to 100 years or something like that in the United States. And I, just anecdotally, I am one data point. I feel so unrepresented by both political parties. It's almost like I see them doing one thing and I'm like, I'm just like, but it's crazy. So, I don't know. I feel like whatever, but I just don't like whichever political party is in charge because they do these crazy things. And I'm like, you guys are the enemy. And then the other one gets in charge and they start doing these crazy things. I'm like, all right. And I just like, guys, come on.
Because we've talked about this. There are no parties anymore. There's in and out, right? You're in, you do or say whatever it takes to stay in. And when you're out, you do or say whatever it takes to get in. And they're all the same. And so, but the difference is they're the same with the same goal, which is to maximize their cabal at the top because we've gone to cronyism. And so what we need is a moderate, middle, actual person who cares. And part of the problem is those people don't want to endure the process. There are a lot of those people. I've met plenty of them, right? And I can envision half a dozen who I would think would be amazing. But they're like, are you kidding me? Raising the money and then having to owe those people. That's the other problem. It costs, so much money to get elected and you have to owe people. And therefore, once you get in, it's like, my favorite is, remember when the election was happening 2 years ago and they're like, oh my gosh, if the Democrats win, oil and gas is just going to get obliterated, the green. And what's the best performing area in the last 2 years? Oil and gas. Like, it's not even close. This year, I mean, it's a bloodbath everywhere else and energy's up a lot. Well, how did that happen? Well, Biden's like, what? They pay me a lot of money? Oh, I love them. I love those guys.
Wait, but just as an example of how hard investing is, you want to know what the best performing currency is this year to date?
Oh, God. Okay, wait. The best performing currency this year.
It might actually be the second. It's the ruble.
Oh, God, I love that. I love that.
Like, how hard is investing? I mean, war, record sanctions, and yet the ruble is I actually love those little data points because it just reminds you how difficult life
That
is.
is awesome. Oh my gosh, that's awesome. Well, and here's the thing. I actually had this conversation with somebody last night. In 1998, August 1998, Russia defaulted and Russian assets just got obliterated. I mean, obliterated. And I happened to be on my way to New York and I met George Rohr, who ran this Russian fund called New Century Advisors. In the airline club, the American Airlines Club at LaGuardia, which was horrible back then, is still horrible now, even though the airport is much nicer, but it's still, the club for some reason is still horrible. And he had a piece of graph paper, like literally the old blue lined graph paper, where he was plotting the RTS, and it was down 95%. He said, Mark, you have to buy this, right? Because it'll go back to where it was. That's a 20 bagger. I'm like, okay, fine. And I was poor. I was working at the university. I didn't have very much money at all. But I did. I went out and I said, all right, find me Russian stock. And there was one listed Russian stock. It was an oil company called AO Tatneft. And at the time, oil was like $11. And ExxonMobil's barrels of oil were valued at like $9, okay, per barrel that they had. AO Tatneft's were 4 cents. Like, a barrel of oil is a barrel of oil, right? So why is one worth 4 cents and one worth, $9? So I took $1,000 and I bought 1,000 shares, not $1,000, bought 1,000 shares, which wasn't quite $1,000. I think it was $1,000 total. Anyway, I split it between my 2 kids, and it went up 40 times. Which doesn't happen very often. And I'm not bragging on me. I was just, this guy said, do this. I listened, which is the key. When someone smart tells you to do something, you actually do it. That usually works out. Not always, but usually. But it was just like right now, I want to buy Sberbank so badly. Sberbank, largest bank in Russia, is not going away, but you can't buy it because they shut it down. Yet the ruble has recovered. And I want to own Sberbank, and I want to own Yandex and a couple other tech companies, because you're going to make 20, 30, 40 times your money when they start trading again. Not immediately, but over time. So I should figure that out.
The last thing, just say, the real way this ripples out into the let's say private markets, right? And I know we got to wrap soon, is all these, the way demand planning works at a company, right, is everyone says forecasts. I feel like forecasts should be replaced as targets. It is target setting. You set your target, and then you reverse engineer from your target into what you can realistically do. Mm-hmm. So the danger, I think the way I've always seen the danger from what the Fed does when they pull and push demand, it makes it very difficult to forecast how real that demand is. Right. So and most demand is created by credit. So what the Fed is doing when they're sucking credit out of the market, they are, if you are leading a business, they are sucking demand out of the market. So I would just be very cautious about, super aggressive hiring plans and everything, because some of that demand that you think is there, that feels like it is there, is about to get sucked out.
That's why inflation numbers are going to collapse, because there is no demand pull. Right. And it's going to get worse. Yep. The economic contraction is going to be ugly, like painfully ugly, and not just ugly for the people it's normally ugly for. It's going to be ugly for everybody. This is going to be a doozy. And that's such a boomer word. God, this is horrible. Doozy.
It's a good word. We don't have to abandon all words. Yeah. Doozy is a good word.
Yeah. But, you're again, exactly right that liquidity drives markets, and we've had the greatest contraction in liquidity in history. And it wasn't because the Fed did it. It was the market front running the Fed's job owning, and they did their job for them. And that's why, I think we're done raising rates. I don't think there may be more rate increases. And I think the liquidity damage has been done, and that demand destruction has been done. And, I saw it. The restaurant that I went to yesterday in Dallas was okay, but not like it was a few months ago. The flight was packed only because American canceled a flight and combined 2, which is their classic trick. I hate them.
God, I hate American so
I know
much.
I know
them so much.
And here's the thing. And the only reason I fly them is because it's the one place I still have status. And status does matter. Like if you can get on the plane first, 100%. It does matter. But as soon as my status goes away, because I didn't travel much last year, I'm changing because it's horrible. And I'm also changing because the only reason I really use it is because I have my, American Airlines card, my Visa card, but they just devalue my miles. Right? I can't get a trip for 20,000 anymore. It's 40 or 60 or 80. So they just devalue the currency. So I'm getting a Bitcoin rewards credit card from our partners at Gemini. And Tyler has promised me I'm going to get one. So I'm waiting, Tyler. So if you're listening, which you probably aren't, but I know it's in the mail, but get me my card. I need my rewards.
I had another portco of yours. So I don't know. Do you remember Riley at Blockworks? He was one of our early employees, one of my best friends.
Oh my gosh.
Yeah. I saw him this last weekend. He's got his BlockFi rewards card, and we were at a bar, and he showed it to the bartender. She's like, "I love that. I've got my BlockFi card. I'm all in on crypto." She's like, I don't know. It was one of those like experiences. It was just funny. Yeah.
Awesome. No, BlockFi is amazing, and they're about to have this massive moat with the new registration for the BIA. And again, full disclosure, one of our largest investments. I had this experience, and I know we do have to wrap, but I did an event up in New York a couple weeks ago, and big crypto thing, and they wanted me to interview Zach on kind of what happened with the SEC, and Zach was on vacation with his kids, and so. I had Flory do it. And I told Zach the other day at a board meeting, I'm like, dude, I'm sorry. I'm never talking to you again. I could talk to Flory all day. In fact, I could have interviewed Flory. We had a half hour. I could have interviewed her for the entire 8 hours of the conference, and not one person would have been unhappy. She is laser sharp, so articulate. I mean, she's the best. And the two of them, and I actually just saw this last night. Co-founder led businesses have higher returns than single founder investors. Now, I don't know if, how big that sample is, and it's because two heads are literally better than one.
If it were, honestly, Jason, if you're listening to this, I am, whenever I listen now, when I hear about single founder led, I am aghast that anyone can do it. Yeah. I'm like, I don't know how anyone could possibly do it. I mean, Yano and I got pretty lucky that we've got very complementary skill sets and get along. I don't know how.
No, the only thing it does violate is the rule that an investment committee should be an odd number and 3 is too many. Because how do you make decisions? But it is good. The yin and yang is really important, and when you have differentiated skill sets, it is nirvana. So. I think you guys are a perfect example of what I just said, and as are Zach and Flory, and actually, Mike Cagney and his wife June are an example. At another one of our portfolio companies, Figure. And I'm not shilling all our portfolio companies, but they're the ones. I
started with BlockFi, by the way. Yeah. I have a super high opinion of their team and their management team and their product as well. Like, we're way over. We got to
wrap, but it's look, it's another bloodbath day. My red pants are gonna get.
I mean, there's no respite anywhere. Like the 10-year is just continuing to push up. It broke 3%, and it's like 3.1 now, and still climbing. I mean, yeah, we'll see. Look, at the end of the day, too. I know it feels different and everything this time, but this too shall pass as well. And I will say, I haven't, this is not financial advice. Basically, if I'm buying, you should do the opposite of what I'm doing. But I have started to look at some stuff in crypto and been like, there are some great protocols companies that have been absolutely taken to the woodshed. And I don't know, this is what creates opportunities for investors.
You're supposed to buy over time. Lower prices are good, right? Because particularly for younger investors, the bulk of your investment will go in prospectively, not retrospectively. So you actually want, on occasion, corrections so you can increase your positions. And look, that is definitely going to happen. The couple things that that could break here. One is oil's back to almost 110. That has to go lower before the election. It will go lower before the election. And whether it's we go on bended knee to Saudi but they're going to engineer that because presidential popularity and gasoline prices are inversely correlated. So that's going to happen. The second thing is when VIX hits 36, again, I was with this guy yesterday. He says, I have a standing order. Just take the emotion out of it and just buy. We're at 32.88 right this second. So that's getting close. You're literally I wish I could show it. The 10-year yield is literally vertical. I mean, it's literally vertical. And,
I know. It's crazy.
I'm super excited that, Top Gun 2 is coming out. I mean, Top Gun
Great
is
reviews,
the greatest.
by the way. Great review. Have you seen the early reviews for Maverick?
See, here's the thing.
Supposed to be good.
Yeah, for Maverick. So here's the thing. Top Gun is the greatest movie ever. All other answers are wrong. And I don't care who you are. And it's just the best movie ever. And there are a lot of other movies I love. I'm a movie guy, but it's just the best. And this is just going to be epic. And I just can't wait. And so, it's going vertical, Mav. Sir, I was only below the hard deck for a few seconds. Commander. So anyway.
Yeah, these are great. All right. We'll get you a cameo in that movie. Mark, we really got to wrap it up here. It has been fun.
Jester's dead. All right. So
cheers, my friend.
Have a great weekend. And hey, we didn't say the word sinister for Sinister Saturday.
No, we did not. I thought we kept it bound. I mean, yeah, I think we did well. I will see you same time next week. Cheers.
Thanks, man.